InFi, episode 34.
Welcome to InFi, the future of finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey everybody, welcome back to the InFi podcast. Today we've got a special treat for you. It's a little bit out of the box and yet still consistent with our mission to equip you with the latest developments in the financial sector. So specifically, my guest today is Lotta Moberg. Let me just read a little bit about her official bio here. So Lotta Moberg is co-founder and co-CIO of Vivify Ventures and Grow Nala. On a voluntary basis, she serves on the board of trustees of the CFA Institute Research Foundation, where she chairs the marketing committee. And we talk a little bit about their video series that they've launched in this interview. Lotta has 7 years of experience as an analyst at William Blair's Dynamic Allocation Strategies team, responsible for global macro research. And that's actually how I met her when she was in Chicago working for William Blair. She also has a background in the Swedish Defense Forces, including 2 missions in Kosovo, and she has worked for the Swedish Foreign Ministry in Russia. Her writing has appeared in economics journals, including the Journal of Institutional Economics, the Review of Austrian Economics, and the Financial Times. She's taught undergraduate classes in economics while at George Mason University, where she earned her PhD. Her research is inspired by Austrian economics and political economy and includes topics such as special economic zones, tax policy, and municipal bankruptcy. She's also the head of the Bastiat Society in Fort Lauderdale. And so at the show notes page, folks, we'll give you links to all that stuff, as well as her book on special economic zones. So with all that, I think it's a very interesting discussion. Lotta, as you can tell from her background here, has been all over the place, but has a PhD in economics, is very steeped in the Austrian tradition, but also has worked a lot in the financial sector. She was, in it in Chicago. And so I think there's a lot we can glean from this discussion. So here is my conversation with Lotta Moberg. Lotta, welcome to the InFi podcast.
Thank you so much. It's great to be here.
So I was just looking over your LinkedIn bio, and you've got a lot of stuff going on here, a pretty interesting story. So maybe we can just start at the beginning. So are you from Sweden originally?
Yes, I was born in the metropolitan of Skellefteå, very northern part of Sweden, closer to the Finnish border.
Okay, yes. Yeah. It doesn't sound like you have a Texas accent, so that's definitely...
No.
So now it's said in there, and I don't know, maybe I'm jumping ahead, but what came first? Did you go to GMU first, or were you in the military and did your Russia stint? What came first?
Oh yeah.
We got to get into this.
Yeah, I was I did my military service right after high school in Sweden. So I did not serve your country. I served my country. No offense.
Hey, I agree with the Swedish foreign policy more than the U.S. So there you go.
Yeah, me too. So I graduated from high school a bit late. I was an exchange student in Australia for a year when I was 17. So wasn't counting those classes, got out and did signal intelligence, 15 months of military service. And then the way it works in Sweden, we don't have a professional army. You sign up for contracts. You can become an employed officer. Mm-hmm. But I did 2 contracts in terms of missions, we call it, in Kosovo. One signal intelligence and the other one, which was called open intelligence, where you can actually just walk around openly and talk to people, which is actually, I found much more fun. You learn a lot about the culture there. It's a great culture. I was mainly in the city of Pristina there.
Okay, so again, we don't need to dwell too much on this, but I think it's interesting to American listeners. So what is it? What does that mean? Did you go through what we would call basic training? Like could you carry a gun and load it and that sort of thing? And
yes, I can carry one and load it.
Throw grenades? All right.
The basic training in Sweden is, the basic period, so to speak, is 7.5 months, I think. It's like the basic, then you're a basic soldier kind of thing. The first 3 months is really the boot camp. That's when you learn how to be a soldier. And then you do whatever you're supposed to be doing in your company.
Okay.
Yeah.
And so what?
And then I did 15 months. So
okay. And so I think, I have a general idea of what signal intelligence is, but can you just be more specific about what did that entail?
Sure. A little bit old school, but actually I learned listening about the Ukraine and Russia war that it's actually wasn't as old school as I thought it was in terms of the technology that we used. You're basically using general radios, like regular radios, and you find frequencies where you hear people talking and then you listen to what they say. So you're sitting in a box,
right,
a van that has equipment in it, and you're just listening. And the way it works is that you're part of a company that not only can listen like we do and find the frequencies at which they are conversing, but also detect the location of them. So you have different stations that you put out in the terrain as well to figure out, okay, they're saying this, and by the way, they're located here. So that's how a signal intelligence company works.
Okay, so the intelligence meaning gathering information that is transmitted back to the higher ups.
You don't have to be that smart. It's not intelligence in that way, yeah.
Yeah, I mean, you are intelligent, but that's not, but doesn't mean in the sky. And then you're saying the difference between the signal and the open. The signal, you're listening like to radio transmissions, whereas the open intelligence, you're just going around talking to people and then relaying anything you learn to...
Yeah, exactly. And by the way, when I talk about the equipment, it's the radio frequencies are just open frequencies that we used, and it's actually apparently what they've been doing, like how they've been able to know what some of the Russian like soldiers and the military units were doing. So that was interesting. And yeah, the open intelligence part is you go out and you interview people. I was in charge of covering civil society, so basically any NGOs. Now, NGOs and international organizations that was operating in Pristina. Unfortunately, Kosovo is kind of known as the NGO nation in the sense that there's so much money flowing into democracy building and things like that. So a lot of young people, instead of going into business and building the economy, they start an NGO. It doesn't mean that the area that I was covering had a lot of really like the most intelligent and well-educated people. I got an exemption to go alone. Often you have to have another person with you if you're like a military person, but I could just like head out with my Glock under my jacket and just like talk to people alone because it's quite secular. They became Muslim when the Ottoman Empire said, well, if you convert to Islam, we'll give you tax breaks. So it's kind of, I feel like it's the culture in that way was a little bit similar to Sweden. And yeah, they're really good. A lot of young people there speak English very well. So that made it easy for me to just schedule my own meetings and talk to people.
That was going to be my next question. I was going to say, like, do you speak Russian?
I speak Russian.
Okay.
But when I went first and did signal intelligence in Kosovo, I learned Serbian.
Okay.
So, because that was the language, that was the relevant one to listen. Then that was all about understanding whether the Serbian military was going to attack Kosovo, basically.
Okay. And then you also were at the Swedish foreign ministry out of Russia. Is that correct?
Yeah, correct. So right after, this is kind of before all of those Kosovo adventures. I went there right after my time at my military service. Because the foreign ministry of Sweden, and I'm sure others do this, other countries, they know that people doing the kind of programs where you're studying really intensely, like it was basically 10 months of learning Russian, and you're a young person, you're very unlikely to be married and have kids. And therefore, they don't have to cover those expenses. And you're very likely to want to do something in Russian and be pretty good at Russian in the state you're at. So that's a pretty smart move on their part. And it's a great opportunity if you're in your early 20s to get a job like that. Yeah.
Okay. So then at what point, what took you, I know you got your PhD at George Mason, which is in Fairfax, Virginia, right? How did that happen?
That happens after my undergrad. I did, basically after my military time, roughly, I realized I want to do something social science. So I started a program in Sweden where you blend political science and economics. And very quickly, it was clear to me that political science was not my thing and economics was completely intuitive and fun. And my first semester of just economics, I had so much time because it was so easy and intuitive. And that's when I read like Atlas Shrugged and had a lot of time for activities as well. Yeah, so then when I finished that, I wanted to find a good program that I'm excited about to get a master's in economics. And I didn't find anything in Europe. There was nothing really obviously appealing to me. And a friend of mine, I was in the free market circles in Sweden. A friend of mine said, hey, you should really listen to this podcast called Econ Talk. And by the way, you should check out where the institution where this person is. And this is Russell Roberts, who is now in Jerusalem. but he was at George Mason at the time. And I started listening to it. There was a lot of connections between George Mason and some of the things that I was involved in Sweden. I worked for a summer at CFA Institute, which is a free market leaning research institute, economics focused. And I worked at Timbro as well, which is a free market think tank in Sweden. And there was a lot of overlap there. So I ended up meeting some of the professors there. That was the only place I applied to do a master's in the end. And I got it. So it was fortunate, yes.
So, I mean, before we leave is there anything, this is maybe a bit contrived, but is there any, like, your experiences in Kosovo and then in Russia, like, did any of that tie into, did that help? Like, did that make you a libertarian, or like, no, it really wasn't like that? Or did you always have those ideas, or you get the idea? Like, is there any kind of connection, or are those just totally disparate parts of your life?
I think I was just pretty late in developing a sense of ideology. And I think that we're really the military service, where it wasn't really the international perspective of it. It was very much more meeting people from other parts of Sweden. This sounds kind of like I've never left my little town, but only then was I really like closely like living with people that I realized that they were completely different cultures and they were not all agreeing. One person, it was a pure socialist, and the other person would be like more growing up being raised like a free market person. There's not really any conservatism in Sweden. Either you're libertarian or you're socialist. And that's just made me think. And I think it was just very intuitive to me, the free market perspective. And I naturally sought my way to those kind of groups when I started college. And those were the kind of friends that I got. And you learn more and more and think more and more and read more and more. And yeah.
Okay. And for our listeners, so she's talking about I think he still has Econ Talk, right? As far as I know, he's still putting those out.
Yes.
Yeah. Yes. So the guy, it's Russ Roberts. He's an economist, and it's he just mostly interviews other economists, and it's very laid back and mellow and thoughtful conversations. They're not trying to, it's not a debate or anything like that. So if you're interested in economic ideas, that's a really good one. And Russ does come from a free market libertarian perspective. Okay, so they accepted you. Now, were you like, did you know about Austrian economics per se before you went over, or did you discover that at George Mason?
Not much, really. Okay. I had read like Hayek. I had not read Mises.
Okay.
And I had not thought about how to integrate it in any way in like how you would do economic research. Several of my professors, I would say most of my professors in Sweden were more free market leaning. But we did not do any Austrian economics.
Okay, but I mean, you had read.
I kind of knew of it, but I didn't.
Okay, but I mean, really having read Hayek, that's. I mean, when you say that, do you mean like Road to Serfdom, or do you mean like his technical stuff? Or do you not?
More Road to Serfdom.
Okay.
Yeah.
Okay. Still. Yeah. Okay. So you can now. So you knew at that point you applied for a PhD program to come over.
I applied for the master's and I started the master's program. My first class was sitting there with Russ Roberts and realizing that if you are in a master's program in the US or really any graduate program, you don't have to have an undergrad in the same subject matter.
Right.
And I had like studied my Slutsky equations. I was ready to go and show them what I could do. And here he was doing supply and demand. And I realized that, this is not what I expected. So what I did was I switched to PhD courses that I thought would just move faster. Mm-hmm. And as I learned from people like, this will move faster. So I quit that class along with switched to Walter Williams micro instead, and all the other classes to the extent that I could switch to PhD classes. So it wasn't really that I was thinking I would do a PhD, but it wasn't that long afterwards that when I got to know my PhD classmates, that it was it certainly got to my mind that that's what I want to do. It didn't take that long.
Yeah. Well, yeah, so I went to NYU, and I don't know the exact numbers, but I don't think most of the people in my program had econ undergraduate degrees. I think a lot of them were math, and a lot of them, and it showed like they didn't know what opportunity cost was, but they were really good at finding equilibrium. So anyway, but that's a separate story.
People think of it as a technical subject, and therefore it attracts people who are like engineers, mathematical people, like you say.
Yeah, and it is. I mean, just for the listener, it is interesting. Well, and I'm curious about your thoughts too. So I went to Hillsdale College, Lotta, for my undergrad, which is very Austrian. They have Mises personal libraries there. That's why I went. And like people are familiar with Henry Hazlitt, Thomas Sowell, Walter Williams, like you said, the free market stuff. And then, of course, the Austrians, like, Murray Rothbard and Mises and Hayek, writing for a layperson. That's so having been steeped in that, that's what I did. And then I was going to go to NYU where Mises had taught also, and it was an explosive Austrian program. But yeah, when you get there, the actual coursework just to get the PhD from NYU, I was there in the late 90s, early 2000s. It was mathematical. Like it was mostly just applied math models that had an economic context to them. But I mean, you were basically, the first year, I was just basically learning a bunch of math. And was that your? And I knew students who were going to GMU while I was, and it seemed like at GMU you guys got more economics at least.
Yeah, for sure. I mean, it was a tremendous time to be there. I mean, the professors are great, and you get to write with them and interact with them in a way that you hear a lot of other universities you don't. They're not as interested in actually getting to know you and talk to you. And we had maths, but it was actually a lot that I had not been covering in my undergrad. So it was new for me, but it wasn't. Yeah, I mean, compared to what you would have gone through, I'm sure it was nothing, just a fraction.
Okay, and then. Did you then go right to Chicago after that, or do I have a gap in your resume?
No, there's no gap there. Yeah,
okay.
We covered it all.
Okay,
so Chicago right after that. Not the University of Chicago, to the city of Chicago.
So so I met Lotta, you were at William Blair, right? I think, okay. So you were working at a, financial firm, and it was the Dynamic Allocation Strategies team is what your LinkedIn said.
Correct, yes.
So that's how I came to know you back when you were in Chicago. So at what point did you decide that, had you thought about becoming a college professor and then or did you know from the beginning, I want to go work in the financial markets?
No, I did not know that. I just like so many PhD students. So for anyone who's not a PhD student and want to be aspiring, you will be applying for a lot of jobs. I applied for 160 positions.
Oh, wow.
Which was about average my class. I certainly know people who applied for well over 200. And I had a mix between Europe and US, thinking that maybe this is the time for me to leave this country and go back to Europe. And I basically had 3 different opportunities, I would say. One was in Spain, and the other one was actually at Ratio. They were starting a great project. It was not a full-time, it was a postdoc position to lead a project that was very like political economy focused, which is what my dissertation was. So in line with that. And then I had the offer in Chicago. And I think the difficult decision was between Sweden and Chicago, because I was very, very tempted to move to Sweden. Stockholm I knew was just a wonderful city, and I had friends there and all of that. But ultimately, just going to Chicago and meeting the team and learning about what I would do and actually getting to apply this, and this would be a job that would be continuing for a long time, and meeting my boss, who was going to be our boss, Brian Singer, and just how everything connected. It spoke to my heart. It was something that told me that this would be pretty, what an adventure to do this. I knew often, that you should do something when you think about what you will feel about not doing it. And then you're always going to wonder what would happen, kind of thing. So, yeah. Okay.
Do you mind just spending a moment on, and you won't offend anybody. I think our audience is not primarily American. I mean, I think it's probably, the biggest group, but I think we're spread all over. So just to be candid, like your experience is just like living in different countries and whatnot. I'm curious what your experience was there. Like did you partly want to go back to Sweden just because you like being in Sweden better than the US, or anything like that?
Yeah, there's something about European culture that you don't find in the US. And it's Sweden, yes, but it's not really. I feel like I'm more European generally.
Okay.
Like I was in Germany last week, and you just like connect on the base. Even Germans, you kind of think like, oh, they're so stiff and all that. But it's like there's still something that you always like connect about. And it's easy to say that Americans are just shallow. It's not quite the right word, but there's something that as a European, that there is some kind of depth that you're missing. And I still haven't found a word to describe it. So there is a difference in culture, absolutely. That was certainly a reason. I mean, my parents are back in Sweden too. So that was my sister and all that. So that's another practical reason. But
one thing I noticed going over to Europe is like just how much older the culture is over there. Whereas in the United States, if there's a town that was established in 1810, it's like, oh, wow, that's an old town. And in Europe, something that's only 200 years old is not very old. So like, I do notice that, like there's, anyway, just as one example.
Yeah, and it's hard to say whether that is, that is not what I care about.
Mm-hmm.
Maybe it has some kind of connection to why people are in a certain way. Sure. But I don't see that. There's something about, what you ultimately care about when you live in a place is what are the people that are close to me and what are the people that are this bigger crowd that are pretty close to me that I'll meet on occasion kind of thing.
Mm-hmm.
And both of those can be important. And yeah, I think that's where the quality of life comes in. And it is going to be, and I've found great people in the US, but I do think it's harder to find really great people in the US.
So we skipped over. What was you said it was in political economy or involved political economy, your dissertation topic?
My dissertation was the political economy of special economic zones.
Okay.
So this is just special economic zones itself is very much in the area of international trade, economic development. And then the political economy part of that is understanding like the political economy context in which they're created and when they work and things like that.
Okay. And so did that directly tie into what you were doing at William Blair or not really?
There were some connections, but yeah, there was actually a tremendous amount of overlap between the broader coursework and what I learned at George Mason that I then applied at my work at William Blair. I did the monetary policy, which I had taken with Professor Larry White at George Mason. A lot of the macro stuff I used and the political economy things as well. We did a lot of like political analysis. We did macro investments. So we were invested on the country basis, equity markets, currencies, and bonds, mostly sovereign bonds. So naturally, this perspective of the political perspective, the economic development perspective becomes very important. So I did a lot of like valuation model work and things like that. The special economic zones thing, it came in sometimes because it's like there are a lot of emerging markets that we would be looking in that people might be excited about them having a special economic zone program, and I can look at it and pretty easily get a sense of whether that is going to be a driver of the economy. And I was invited to do some talk in the industry because of people being interested in the topic. But it wasn't like the biggest part, I would say. A lot of it was just the broader economic education and training that I have from George Mason.
Right, and correct me if I'm wrong, but so the person, like your direct boss there that you interviewed with, Brian Singer, he also was a fan of the Austrian school, right? Because like you guys had like a reading. I think that was like partly how I got to know you guys. Is like I would Skype in for some of your book club or something, right?
Yes, thank you so much for doing that. Yeah, so I have been on a perennial quest in the US of finding good people, and the way I'm doing that is just starting things. Start a book club and We recently, and this is a big plug here, started the Bastiat Society of Fort Lauderdale. We are having our second speaker coming up in about 3 weeks. So that's exciting. The head of Free to Choose Network, the CEO there, Rob Chatfield, is speaking. Last one. And in Chicago, yes, we had a meetup. We had the Austrian Economics and Libertarian meetup. And I'm sure we invited you to that, but that was more like meetup means it's open. So you meet somewhere and people come. We have a book club that was very much with the people that we have found through friends that were this core group of really good and smart people, where we would read like bigger books. Like we would call it first a TMS group because we read Theory of Moral Sentiments by Adam Smith first, but then it kind of became just the book club, free market book club.
Right. Okay, so I guess for the listeners who are in the financial sector in various capacities, an obvious question that I would get a lot is: did that give you guys an edge? Like, so Brian having that that element of his worldview, and then bringing you on, like, was there a thing where you thought, yes, our team, we're going to have better returns than some rival team that's just as competent, but they haven't had this exposure to the free market economic perspective?
Yeah, I definitely think so. Like you see, there's so much when it comes to macro. There'll be a narrative around some development, and people latch on to certain narratives that if you don't have the political economy kind of perspective. You want analyzing in the right way, and narratives that are very, when you apply any economics to it. I mean, there's a lot in the finance journalism. Okay, great. You got an undergrad in economics where you picked up the basic Keynesian stuff, and you see that everywhere, and people believe it. It's like this whole inflation drives growth or stuff like that. And you actually see that when you look in the numbers and there's a new inflation number reported and people get kind of optimistic about it, or just analysis when you do evaluation, people assume have different assumptions of what drives growth, right? I mean, we introduced a really core part of our valuation work was looking at economic freedom in the world. So you have the Fraser Institute having the Economic Freedom Index, and applying that and seeing, okay, where is this country going? Can we assume there's some good literature, there's some good scholars having written papers whose names I won't remember now, but looking at both the trends and does it tend to be a mean reversion? If it's really high, maybe we'll go lower, all those kind of things to try to project what could be those kind of drivers of ultimately productivity. I mean, you can think of it a little bit in that neoclassical framework, like the Solo model, right? You have like the capital, you have the people, and then you have this productivity part. And the productivity is, of course, what drives the whole dynamics of the model as opposed to an static equilibrium. And that's very much, I think, in its basics, I think it's the right way to think about it and not be too fooled by hearing that capital is flowing in somewhere. Well, do you have the institutional foundation to sustain that or not? So a lot of perspectives like that I could go into. That I do think that we had a very different analysis. I would meet with, sometimes there'll be analysts who are trying to sell you a product or something like that, and their chief economist is there. So many people, you won't believe how many people actually fall for, say, the broken window fallacy. So they'll be like, oh, well, it's great that they have an earthquake now because GDP is going to be higher because they have to rebuild the whole cities. Right. And it's just like, what are you talking about? Like, it's true that it's going to be, but we all know how artificial and short-term those kind of numbers are.
Yeah, and just for the benefit of the viewers who haven't heard that, so it goes back to Bastiat. You mentioned the Bastiat Society, but that was one of the classic things he wrote about. It's called the broken window fallacy, where the story goes, there's some hooligan kids and they throw a rock or something and it breaks I forget what he is, a baker or something, his window in his storefront. And so he's mad and everyone's mad, but then some wise man from the crowd says, well, no, if you think about it, it's a good thing that those kids broke that window because now it'll give employment and income to the glazier who has to fix the glass, and then he'll go spend it down with the cobbler when he buys new shoes. And so it's like these kids somehow not magically, but raise the income of everybody in the community. And it's and of course the fallacy is the money that was spent on that could have been spent on something else. So the employment would have been the same. It's just, you wouldn't have been started out down a window. Like, better to have all those people working and creating new wealth rather than just replacing the thing that was destroyed. So, likewise here, if there's a hurricane or an earthquake, you can go, that quote creates employment in those sectors to fix that stuff. But the workers, with flexible wages and prices, those workers would have been doing something else and adding to the net wealth of the country rather than just replacing what nature destroyed. So
exactly. No, thanks for that clarification.
And for you a lot.
No, but yeah. And also like other models in undergrad where you have GDP equals consumption and investment in government spending. So you get government programs, and you actually hear like the analysts saying, well, government spending is going to go up and that's going to be good for the economy, and therefore you should like invest in this country. And they can bring out that because Keynes said, right, it's a mathematical fact. If you're educated, you know this. So things like that you don't have to fall for if you have some a little bit more deeper and specifically, certainly free market Austrian education.
Yeah, and even some of the real technical stuff, I know this was actually a lot of, I don't know how much I relate to you guys, but when I was talking to you and Brian there when I was actually trying to figure out, because folks, I spent some time in Chicago at this period where, when they were there too still, so it was overlapping, and I was trying to see if there was something like, I was basically trying to get Brian to give me money to do something on the side, and then it just didn't work out. But what I wanted to do was, like when I was at NYU and I noticed like even like in the hardcore finance literature, they would have these models that involved interest rates, and they just assumed like, it follows a stochastic, process, and it's a random walk with this drift, and like they had no theory as to what makes interest rates do what they do. And I thought, well, surely that you could have some predictive power if you knew something about why interest rates move the way they do and didn't just view it as this like black box. So anyway, there's lots of really smart people in the financial sector that are really good at this narrow thing. But when they start talking about bigger causality, like you just know, no, that's not right. And surely, at least in some settings, the fact that they don't know what drives big trends, that would presumably lead them to make bad investment decisions.
Right. I mean, interest rate, it is a more technical discussion, but I think that has been a very intriguing topic, and we've talked about it. I would say that they're both from economists and then financial people, you get different kind of what I would see as the common fallacies that I come across. And I would say on the economic side, it's very much this neoclassical view. And I would say that it took me a long time to figure out kind of why often doesn't really make sense. So the neoclassical view is basically like savings and investments, and it's supply and demand, and here's the interest rate. And that's kind of how you learn in undergrad. There is really no research that I found to substantiate that. And when you start looking at kind of the movements of interest rate that we had, it has been the central bank pressing interest rates down. And any data that people use often start in the 80s. So you basically have like Greenspan coming in and starting this kind of trend of, hey, why don't you always get the real rate as low as possible? And that has kind of been the aim for a long time. And so I mean, who would believe that interest rates being high now are because of supply and demand of money? Like we know what happened. They printed a lot of money because of COVID, because they shut down the economy. They, as in the central bank, printed the government after the government shut down the economy. So that I think is more battling like the neoclassical perspective that I would disagree with. And you can find some research going back a few decades, and you can fit like a demographic dividend kind of curve or dependency ratio curve pretty well over a certain period of interest rates going up, like real rates, and then going down. But one definition of real rates is not that easy, because if your rates is a forward-looking concept and inflation is a backward-looking concept, so you have to assume that people have perfect foresight about inflation for you to say like this is the rate that they felt was right at the time. And then on the finance side, I would say there are different views that you can say interest rate. Like you can stack it up as like some kind of the risk-free rate and then the risk premium, for example. And that's usually how people think of it. But the other way of thinking about it is from the demand side, so to speak, which is similar to the economics perspective, which is there is the time preference. You have a time preference, and then on top of that, you have some kind of risk premium. And then if it's whatever else is your cash flow, it might be an illiquidity premium or default premium if it's a bond or things like that. And there, the big question also becomes like, what is this thing about the time preference? There is this assumption that you always want more now, and then people are myopic and things like that. And I haven't really seen that. So I'm still like on the camp of disputing that is actually like a real thing. Because the other aspect of that is research showing how suboptimally small consumptions are for people like our students, for example. Like if you're in a PhD program like me, I was definitely falling for this fallacy, if you'd say behavioral flaw, whatever you would call it, which is you spend too little in terms of like you find the cheapest little place, a little room, even though you're in a PhD program. Like if you look at the probabilities of your lifetime earnings, you're probably gonna do okay. It's okay. Like you can have an apartment. So I've come across this a lot, like in wealth management, for example, in finance. It's a lot of this. When you're advising a client, you have to either adhere to or stem their proclivity to always want to spend today rather than tomorrow. When in fact, a lot of people are actually way too frugal for their own good, if you would see it in some kind of objective sense. I mean, you can always put in your moral hat and more own perspective on it.
Well, yeah. So this, is tying into a couple months ago here at Infinia, we were dabbling in some like in terms of like annuities and things like that. That there is this phenomenon where there are some like older retired people that, in some sense, they're not consuming enough. They're too afraid that they're going to die and not have, or that they're still going to be alive and run out of money, and so they end up, managing their affairs where ex post, like, oh wow, yeah, you were way too frugal. You should have enjoyed your retirement more, but they were always in this high state of anxiety because, oh no, I don't want to be a burden on people, and that's part of the function for if you had a well structured annuity or other types of possible structures. But so also, Lotta, I don't know if you know this, but like my dissertation was heretical. I was challenging the Austrian pure time preference theory of interest. I said, I said not only was it wrong, but it wasn't even Austrian, and I was trying to show how this isn't an Austrian theory anyway. But that's more technical than this podcast needs right now. So anyway, you're not offending me by challenging that. So since we're getting into some technical stuff, one of the other hats you wear is you are on. Is it like you're a volunteer but part of the board of the CFA Research Foundation? Do I have that right?
Yeah, CFA Institute Research Foundation. Yeah.
So can you just explain what that is first, and then we'll talk about the video series?
Sure. Yeah. So the Research Foundation of the CFA Institute is an independent research organization. We basically publish pieces, practitioner-oriented, high-level, standing the test of time kind of pieces. It's not comments on the latest developments or anything like that. It's thinking about really like profound questions in finance. We do have quite a lot of pieces to also look at specific topics like ESG or ETFs and things like that might not be more like literature reviews. But quite a lot of our topics are, very like informative or high level think pieces. So one that recently came out was a collection of chapters, different authors on private credit, different kinds of private credit, venture credit, infrastructure, all that kind of stuff. And so that's more kind of informative, but very broad kind of views on the topics that we write about. And I was co-chair of the research committee for a good while, meaning being the one who decides what ultimately gets published. And then I thought we should do more on the marketing side. So switching from that and now head of the marketing. And that's what I started doing, some videos, and we're now on social media and things like that, as you mentioned.
Okay, yeah. So, and of course, for all this stuff, folks, I'll put links so you can, follow up on any of these things that we bring up that are interesting to you. This is episode 34, folks, of the InFi podcast. But yeah, so I was reviewing some of those videos. Several of them mentioned this phrase alternative credit. So can you just explain what that means?
Yeah, that's we did a series of 4 videos on one piece that is this collection of like that I was talking about. So alternative credit is basically anything that is not your standard, basically not a loan to a public company, more or less. Like it encapsulates lending to non-public companies, private companies that do different kind of like investments in different areas. As I mentioned, like it could be infrastructure, it could be venture, other things, like whether it can be like, it's a blurry concept. So that's why I'm a little bit hedging here. It can certainly be a regular bank lending to a company, but it's usually is that company being like a startup, like private or in some kind of niche sector.
Okay. And so for people who are like, what sorts of things are like? Are there innovations? Is like technology helping to transform that area?
Yeah, that's a really good one, because often you think of, if you come across it, you can invest in, say, private credit to a credit fund. You become a limited partner. There will be a general partner, and that general partner will often charge a management fee, meaning a fee of whatever money you put in the fund, and then a performance fee. So if it goes up 10%, maybe that person will take 2% of that, like a 20% kind of performance fee. So that's something that is available for people who have some money. You need to figure out where you're going to go. But there are innovations out there. There are public companies that basically invest in, that make those investments, just like a bank making these private lending. and then you can buy equity into that company. They're not gonna like always perform. Like, they're not gonna perform the same as the credit. But here's the kicker: when you talk about these things, like if you think about it, like what cash flow do I have a claim on? Right? I can have it on this one fund. Was that one scenario where we're saying if that company we're lending to is paying back money, there'll be kind of a tax on it because of the people managing the fund, and then you get some money. The other way to do it is to invest in a company that does the lending, and then you have a claim on the success of that company, which should kind of reflect the extent to which these loans are successful. If there's a default, you're going to go down, decrease. What people are not so excited about, which has become so funny in this world, is the fact that you actually have way more. You obviously see prices. You can see prices continuously if it's an equity stake in a company that could, and this would be a public company that does the private lending. Whereas if it's a credit fund, you would not know what the return is more than maybe there will be payout like a certain periods, like every quarter, and you cannot take your money out. You pledged a certain amount of money, you committed this capital. That means that you're getting it back at the end of this contract. And that contract can be a 10-year kind of thing. So what people actually like about that is this psychological, like, well, you're not tempted to pull your money out in the bottom of the market.
Okay.
And I'm kind of skeptical on that view generally, not trying to sell one product or the other, but in the sense like this, what used to be an illiquidity premium is not considered an illiquidity premium anymore because it's assumed that it's actually good to lock your money in. And it's good to pay the extra kind of fees, so to speak, to lock your money in, which is of course still against the textbook theories. And I don't think really it makes sense. There's also this.
Can I stop you, Lotta, just to make sure the listeners get it? So you're saying it's not that, of course, from the company's point of like the people getting the funds, they benefit from being able to lock it up to know that, oh yeah, this isn't going to get called back at a moment's notice. Like we can put this to work and have a long time for it. But your point is traditionally the thinking was, oh yeah, for you as the outside investor to be willing to lock your money up, you should be on the front end getting a higher expected return,
right,
to compensate you for the fact that, well, geez, if I was rolling it over in T-bills, I could get my cash out pretty quickly. Whereas here, if it's like, but you're saying now that there's at least a school of thought saying, in other words, it's not a penalty on the company. It's like you want to penalize you want to take away the option from yourself to be able to pull the money out, to be able to like protect against your future irrational behavior.
Right.
Okay.
Tie yourself to the mast, so to speak.
Yeah,
and it's a little bit like part of this, why I feel like that contrived thing comes about is that people model, you're probably familiar with, if you have an asset in finance, you look at the return and then you look at the risk. And the risk is not what the normal person would think, like, what is the risk of me dying tomorrow or something bad happening? The risk is measured as this concept of standard deviation. And if you have an asset that does not report changes in its value, its standard deviation is going to be very low because you don't see how things are actually moving. You're blind to it. So in many models, like there's still like, there are different ways of doing this. People do, adjust for in different ways, but there's no like surefire way in which you could say, I'm comparing apples to oranges here in terms of, if I have apples to apples here, in terms of equity and its volatility, which is constant and I'll measure every day, can measure every second, of course, but let's say I do daily. And this one, the private equity or credit, really, anything that you're locking in and you don't see how the value is changing. And that is kind of a fallacy in finance where people are saying like, oh, this one, like you see this people writing in finance saying, oh, it's so good because it's lower volatility. So yes, there's the liquidity premium, but on the other hand, the volatility is lower. When it's, of course, just volatility behind the veil, it's actually more risky because you don't know what's happening behind the veil.
Okay, so
it doesn't mean it's the bad asset class at all.
No, I get what you're saying, but it is some of the debate. Well, that ties into, because I wasn't sure whether to bring this up, but since you just brought up risk and return and volatility, another one that like I was just geeking out on of these interviews, just to give our listeners a flavor of what's here if they want to check it out, is you had two guys on talking about a paper they'd written on Harry Markowitz, who is the father of like modern finance theory, portfolio theory. So I don't know, do you want to speak on that a little bit, and then maybe I'll have a follow-up?
Sure. I mean, Markowitz generally, so he was, when you say modern portfolio theory, that's generally what we connect to this, a frontier that says if you're picking the highest return for any given level of risk, then this is going to be the combination of different portfolios that you would choose. And for every portfolio on this kind of a line, so you have like a y-axis and an x-axis, and when you and on the y-axis you will have the return, and on the x-axis you have the risk, and it won't be a straight line. It will always be so risk is something bad and return is something good, and therefore it's going to be a positive slope, meaning you're always going to get a little bit good with the bad, but it's also going to have a bent curve just because of how the math works. So the modern portfolio theory approach is to say, okay, you can optimize. It's all about like kind of finding this optimal portfolio for each level of risk. So again, like if you have this one portfolio, then you could ask, well, what if I move in any direction from here? Well, either it's going to be an impossible portfolio that is not obtainable to you, or it's going to be one that either has higher risk or lower return. So therefore, you can create this frontier. And then just like in economics, you can think of it as there's also a utility component to it. And I don't know how technical the audience is, but if you think about what your preferences are, there too is going to be a positive slope between risk and return. You are going to want to say, well, if I'm going to give up this return, then I at least want lower risk to some extent. Now, that curve is going to meet the other curve at a point where you can say, well, for this specific individual, it will be in this specific portfolio that is perfect on. And individuals are different, not because they face different returns, because that's just an objective fact, presumably here, but because they have different risk preferences, meaning how much is it important that we're adding standard deviation here. Now, there's a lot of problematic things here that we can go through, but one is just, of course, standard deviation is not something that people actually eat for breakfast. It's not something you care about. If it's volatility on the upside, you can be really happy about that. Mm-hmm. But we measure it only in one way, which is the volatility means standard deviation. So that's one thing. And I can go on. Yeah. So, and then the question is, and what those authors of that paper about Markowitz pointed out was that Markowitz himself, he and this is, by the way, Harry Markowitz he went in not as, he ended up getting, I think it was PhD in economics at Chicago, and nobody really understood where his piece was going. It didn't fit in any bucket, and therefore he ended up in economics. And I think he was under Milton Friedman.
That's what right. I think it was like 1952. I think is when he got his PhD.
Yeah. 52 is when he published that paper. Maybe it was the same year. I don't know. Sorry about that. But yeah, the paper that is like the really famous one. Yeah. So what he himself pointed out is, I give you the framework. I don't know how to put in the data here. There's no objective, I'm not saying that we know what these data are. It's like, if we didn't know what the data were, then we could actually optimize.
Right.
And then what the industry has done is to say, well, let's assume that we know what the data is, and let's come up with a way to know what the data is. And that's when people do trend lines of equity markets or all kinds of stuff where you just have to, or other kind of analysis where people come out and say, we believe that these returns are going to happen, and therefore if we have this optimal portfolio, this is where we're going to land.
Okay, yeah, interesting. So what's interesting about that, Lotta, is I had a guest, this guy Christian Hubbs, that we ended up, he's actually working with Infinio now, is because he's got a PhD in machine learning on our AI initiatives, but he also had done some work. Anyway, there was this guy, Mark Spitznagel, he had run a fund with Nassim Taleb, the Black Swan guy, and Spitznagel in his latest book, he challenges that whole framework, basically saying, in standard finance, the way they teach it, there's this trade-off between risk and reward, risk and return, and that, if the higher return you want to get, you have to be willing to tolerate a higher risk, but that's not how he thinks of it, because in his mind, it's more like, if I'm reducing the risk of a loss, especially if it's like a longer time horizon, that's the same thing as increasing my expected net wealth at that point in the future. So in his mind, because he's got a lot about hedging strategies and stuff like that, having safe assets and safe haven assets and things. So anyway, it's obviously not like that Harry Markowitz's math is wrong, but it's almost as like the framework that they're using. And it took me a while to to see what the two camps were saying. But anyway, so it's...
Yeah, it's a little bit like a DSG model in economics. It's like, yeah, I can't dispute that there is a trade-off, that the pluses and minuses are right. It's just that when you put in all the numbers in there, it becomes very insensitive to your outputs, to your inputs. Like the outputs change a lot depending on your inputs. Mm-hmm. So I haven't read that book by him. And speaking of books, Brian Singer and I, he's now my business partner, who was my boss at the time, we are finalizing a book that really very much criticizes that framework as well and builds on it. Because the way that I started thinking about it, and also both of us really, is when the data actually, the Economist had an article about this a few weeks ago, how there's new research coming out that they don't even find a trade-off. It's not even like positive. And now people get confused. So one, are we measuring risk wrong, or is it the whole framework wrong? And the way that I'm thinking about it, you mentioned like him talking about it like in the long run kind of thing. Really, a lot of investments boils down to your time horizon. If you're having a long time horizon and you want to be kind of a passive investor, meaning I just go along with the market. It could be risky, but I try to have as broad a portfolio as possible. And if others go down, if I go down, others are going down too. A little bit that mentality. The world is not only public markets, so you would have private in there. And the illiquidity premium, if you are planning to hold something for many decades, is not an illiquidity premium at all in that case. If you want to have a shorter time horizon, it becomes very different. There's a lot of trade. You can be a day trader, and you can do momentum strategy even that is not in any way connected to fundamental values. It's just a matter of like, what kind of skills and willingness to, what kind of like time horizon do you want to focus on really? And I think that when we're seeing this, like some researcher picked some data, they picked some time horizon, can't remember which one in this case, and they assume that the trade-off is going to work in each time horizon. They assume that there is certain premium for this kind of uncertainty, this illiquidity, and so on. And it turns out it doesn't work. Well, it might be because the time horizon that you're thinking about, the risks that you're considering don't actually matter that much. But there are other risks maybe that are going to matter much more. And that I think is actually, what time horizon people wants to have is actually much more a determinant factor than the old kind of risk reward framework. Markowitz is kind of, it's illustrative. It makes you think about a lot of things. I think it's really useful and illuminating. But it doesn't get you that far when you try to think about how things actually work.
Yeah, for me, all of that, mathematical economics stuff, it's fascinating, and to me, it's good. Like it's very rigorous and precise. So you can really isolate the implications of certain assumptions. But to me, it's not that, and so whatever these models pop out, that's what you should go do. But it's more to say, if I want to think through in my head, what would be the implication of tweaking this variable? It's like a wind tunnel chamber to test, or a simulation to test that out. But you're right, there's so many different moving parts in the real world that that I would never just assume that, we've got all the important variables under consideration. It's just more to run through the implications to make sure you're thinking of something in a consistent fashion. To me, to give an example, for you, Lotta, but the listeners too, of relying on Spitznagel's framework, what I had done, because in the Bitcoin world, there's a lot of people, I'm sure you've seen a lot of that, they say, just hodl, just keep holding. And if it goes way up and you're tempted to take profits, no, that shows you're emotional. No, you got to just hang on, just do nothing but buy and hold forever. And I actually went, and so in Spitznagel's framework, that's too risky because it's a very volatile asset. And no, you should hedge somewhat. And so one might think, you've given like a Markowitz time frame, you might think, hedging like reduces the range of what's going to happen. And so yes, it makes my lows higher, but it makes my highs lower. And so it's safer. But for the true, believer in Bitcoin, you should just go all in. And I showed that if you use the historical data, like I think I head back to 2010 and just looked at the annual returns. And so for some years, it's crazy. It's like 6,000%, whatever, and crazy growth in Bitcoin. But some years it goes down a lot. And I think the optimal thing would have been, if you're doing annual rebalancing between Bitcoin and cash, it was like 96% Bitcoin, 4% cash. right? So don't get me wrong, that's a high allocation to Bitcoin, but the point was it wasn't 100%. So even given, from either way, you were going to be, if you had a bunch of money in 2010 and put in Bitcoin, you're going to be a billionaire. But the point was you would have been a bigger billionaire if you actually had a little bit of hedging involved. So the point being there, it wasn't a trade-off. It wasn't that, if you have a little bit of hedging and when it goes way up in a year, you put some in cash, you do some, profit taking, and therefore you sleep better at night. It's also, this is how you have more Satoshis under your belt 20 years from now. So there wasn't a trade-off, in that sense between being safer or less risky and maximizing the growth of your portfolio. So that's the kind of thing. I don't know if you want to say anything about that, but I'm just trying to be specific and not just speak in generality so people understand. I realized that when I was thinking about Spitznagel's framework, no, there really is something here. And you're so used to if you're coming out of that other framework, it's so hard to break out of that.
Yeah, first of all, hedging, you can do this in different ways, but if you think about it like an option, an option means that you can basically cut your losses, but at a price so that whatever the gains are going to be slightly lower. And that's, one way of thinking what you're saying. I think if somebody hear that you're going to cut off the tops and the bottoms, they might also think about what we would call a collar, but that's not like a normal world. But basically that you're both buying an option on the downside, also selling it on the upside, meaning if it goes up, then you're not going to get any more of that. So that's both. It's something that if you hedge all the time, you tend to lose out because it is always quite expensive, which probably Spitznagel in his fund maybe discovered. But yeah, so I mean, it is difficult when you have an asset where people dispute whether it's going to exist at all in the future. Because I mean, with something like Bitcoin, if your time horizon is long, just hold on for dear life. It's not. It can be absolutely the right strategy. And it's whenever one says buy the dips, a dip is always a backward-looking phenomenon. You never know, you're in a dip. You often think that you're in a dip, and you buy the dip, and you're like, I was not in a dip. That happens a lot, And it's as investors. I mean, maybe there are some people who believe that I go in here because I can predict the market better than others. But a lot of investment is really about just thinking about long-term asset allocation, what philosophy you have behind that, what you think kind of makes sense, as opposed to picking the turns of the market. Maybe you could say that Bitcoin has been, at least so far, a very clearly big narrative around it. And therefore you can have a sense of oh my God, there's what Warren Buffett would call blood on the streets. Everybody is pessimistic. Everybody hates it. This is going to be a great time to buy. Those kind of mental sentiment kind of indicators could sometimes work, but it's more about that than probably reading the chart.
Yeah, exactly. Okay. Well, I think we should wrap up there. So besides pointing to your video series, now you actually have a book on special economic zones, right?
Yes. Yeah.
Okay. So we can point people to that. Is there anything else I missed? The Bastiat Society, is there a link I can include for anyone in the Fort Lauderdale area?
We'll include the link at if you can, at the show notes here. That's Fort Lauderdale monthly. We're meeting monthly for that. So welcome any good people from academia or industry. It's very much a project by the American Institute for Economic Research. They host that. My book is The Political Economy of Special Economic Zones. It's the only book in my name that you'll find on Amazon. So it's pretty easy to find. We're hoping to soon launch our book on asset allocation. We've been working on this for a long time, Brian and I. So hoping that we get a good following around that and that can provoke some good conversations.
Okay. And the name of your show, your video series, is the Financial Thought Exchange?
Yes. Okay. So that's the video series that is hosted by the CFA Institute's Research Foundation. The CFA Institute, for anyone in finance, would have heard about it probably. It's the biggest organization in finance. There is a certification that people have, which is called a Chartered Financial Analyst certification. So a lot of people going into the industry do that. And then there's a lot of things around that, a big community. It's an international organization. And then Research Foundation is closely affiliated with that. It's been since its birth, but it was born out of donations to pursue independent research and be a very like independent organization. There's nothing like it out there. Any other finance research would be either, there's a lot of academic research that is great. And there is also great research that comes out of a lot of companies. But those companies, they're always, have their specific agenda, or we want to write about this because, it's something that you want to be popular about, or a topic that you want to sell, or something like that. So it's a volunteer effort, and we're all doing our best to make it a great organization. We have a small board, but of some really great high level people.
Okay, great. Yeah. And so like I say, folks, the videos are very interesting. It's rigorous, smart people, but you guys speak in plain English, so like the average viewer can understand what you're doing. Okay, well, my guest has been Lotta Moberg. Lotta, thanks for your time.
Thank you so much. It was great to be here.
Thanks. And maybe when you and Brian have your book come out, let me know and we'll have you guys come back and talk about it. And thank you folks for tuning in. We'll see you next time.
This concludes another episode of InFi, The Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.